What is the real cost to you of choosing to outsource your retirement investing to third parties? Investing $10,000 via managed or mutual funds, 401ks, financial planners, investment or robo-advisors could potentially cost you $11,000 over 10 years, more than your original investment, or $70,000 in 20 years, $336,000 over 30 years, or $1.437 million over 40 years. I'll explain the logic behind these numbers in a minute, but before I do that, let the gravity of those losses sink in. Then imagine adding another 0 or 2 to that $10,000. You see, choosing to outsource your investing to managed funds, financial planners, and the rest protects you from two things only: the negative feelings that always come from losing, being wrong, missing out, and not getting more out of the deal with the benefit of hindsight. Or secondly, the hassle of managing your own investing. As you'll soon see, getting your investing entirely done for you comes at a hefty price, paid in your investment returns through the fees you pay, and as a consequence of the lost returns through over-diversification. I'll go into a bit more depth in a moment. Plus, it opens you up to the biggest investment of all, not having enough money to enjoy a worry-free and financially self-sufficient retirement. Before I give you rock-hard numbers that will back up my claim, consider this. With our lifespans increasing, you must now prepare for 25 to 30 years of retirement, meaning you need to have enough funds to enjoy the same or hopefully even better lifestyle than when you were working. If you do the calculations, you'll discover that saving 12% or less of your monthly salary while achieving 8.5% or less annualized returns over a lifetime of working and investing will not be enough to last a 25 to 30 year retirement at your chosen lifestyle. Do some more objective research and you'll find that it's highly unlikely that third-party money managers like brokers, financial planners, mutual funds, 401ks, asset managers, robo-advisors, etc. will consistently achieve more than 10% annualized returns over 30 plus years of investing. But as a do-it-yourself investor, DIY that is, you can, with the right mindset and investing process, get 12% or even 14% annualized returns or more. Don't let the financial fraternity convince you it's not possible. I've done it myself, and so have many of my customers over many years, and there are plenty more examples beyond my customers too. Sure, going down the DIY route is far from easy. It involves working on getting the necessary investing skills and facing primal fears and emotional pain. But it is your best bet for having enough to enjoy a financially self-sufficient retirement. That's because of the difference in getting 12 to 14% annualized returns makes in comparison with the maximum of 10%, but more like 6 to 8% annualized, you can get by outsourcing your investing to nearly all third-party investing options. Allow me to explain. What is the actual difference an extra 1% of annualized returns make? To understand the gravity of this difference, check out this Table 1 entitled Capital Growth Multipliers based on Annualized Returns. The numbers in the table are capital multipliers achieved by each of the annualized return percentages. They show how many times over your capital will increase if you achieve the returns that go with it. So in the absolute best case scenario, outsourcing your investing to third parties puts you in column 4 of the table, that is 10% annualized. The do-it-yourself route, if done well with a battle-tested system and the mindset to execute it through thick and thin, puts you in columns 5 or 6. To see the difference in dollar terms, let's say you start investing at the age of 25 and have $5,000 of starting capital. If you get 6% annualized returns, you'll have $9,000 or 1.8 times more in 10 years. With 8% annualized, you'll have $11,000 or 2.2 times more. 10% annualized, $13,000 or 2.6 times more. 12% annualized, $15,000 or 3.1 times more. But with 14%, you end up with $18,500. Now do you see why I said outsourcing your investing to third parties could cost you $70,000 over 20 years or $1.437 million over 40 years if you start with $10,000? It's the difference between achieving 10% and 14% annualized returns. That's the power of compounding. Also, remember I've been kind to the financial fraternity and the like, as they usually don't get close to those 10% returns over the long term. How do I know this? Let's turn to the SPIVA Scorecard and persistent reports. These reports show that managed equity funds can't beat the total return index of the stock market over the long term. For example, according to the S&P Dow Jones Indices, Australian SPIVA Scorecard, 80.89% of Australian equity general funds were outperformed by the ASX 200 accumulation index over 15 years to June 30, 2023, and 80.86% over 5 years. The source for these is the SPIVA Scorecard and persistent reports, which you can look up yourself. In the US, it's even worse. In the United States, 92.19% of all large cap funds underperform the S&P 500 over 15 years to 30 June 2023. You see, there is a trade-off you make when outsourcing your investing to third parties. Outsourcing your investing only helps you avoid the emotional hurt and negative feelings that come from the 4 primal fears of losing, being wrong, missing out, and leaving money on the table. Sure, these fears will regularly hit you as a self-directed investor, and outsourcing your investing mostly, not entirely, eliminates these feelings of hurt because you're not looking at your portfolio account nearly every day. But in doing so, you also sacrifice the opportunity to achieve the returns you actually need for a financially self-sufficient retirement. If you really want to ensure such a retirement, you must outperform the index by at least an average of 2% annualized consistently for many years, and beat the best mutual funds and other third parties by around 4% annualized over at least 20 years. The worse your investments have performed up until now, the bigger the required annualized percentage return becomes going forward. And the SPIVA Scorecard and persistence reports show that third parties don't come close to this. My calculations show that the stark reality is this. If you want to enjoy your golden years, you have to save closer to 15% of your monthly salary for all your working years and achieve better investment returns while you're working and are retired. 12% annualized returns would cut it, but if you achieved 7% or less during most of your working life, you'll need even more than 12% annualized now and for the next few years to catch up. In other words, you must come as close as possible to the right side of this table. And no third-party investing options can get you there. There are 2 reasons why outsourcing your investing won't consistently get you more than 10% annualized. The first is percentage-based fees. Consider the percentage-based fee listed on your fund manager's statement. The financial establishment presents it as the only cost of your services and expertise. Yet the truth is, it's just a teeny-weeny part of the price you pay. Let me explain. Everyone knows that the more you make, the bigger this transparent fee becomes. This part is clear, and some even think it's a good incentive. But what about the growth side of the money that goes to your fund manager? If the money foregone from fees was still in your pocket, you could have invested it and earned a return on your investment, and you could have reinvested those returns and earned further returns. The more time that passes, the bigger your losses get. That's because the compounding effect works the same for your fees as it does to bring you superior returns, but against you and for the fund manager's pocket. Plus, on top of these mutual fund fees comes the cost of financial advisors. For example, 66% of IRA self-directed investors in the United States use financial advisors to manage their mutual fund investments. The difference typically paid in recurring fees to said advisors is around 1% per year of funds under management for face-to-face, but less for online or robo-advice. And you pay the fees for the rest of your investing life. Note, I'm not 100% against having a financial advisor. This can be beneficial, but you should pay them a one-time flat fee for their specialist services, instead of a percentage-based lifetime fee that scales higher and higher as more time passes. This combination of advisor fees and active mutual fund fees will potentially cost you hundreds of thousands of dollars in direct cost and loss compounding over a 20-year, 30-year, and 40-year period, as you've seen in the examples above. Here's a famous quote by John Bogle, the founder of Vanguard. What happens in the fund business is that the magic of compounding returns is overwhelmed by the tyranny of compounding costs. It's a mathematical fact. The second reason why outsourcing your investing won't consistently get you more than 10% annualized is over-diversification. Mutual funds and the like tend to engage in way more diversification than necessary to keep your assets safe, leading to stifling your investment growth. This is excess caution, as author and investing consultant Charles Ellis calls it in his book, Winning the Loser's Game. Look, when done right, diversification is great for protecting your wealth, but engage in too much of it like the balanced and target date funds do, with up to 80% of your savings, and it will hamper your growth potential more than it protects you from market crashes. In most cases, taking personal control is the only way to get the investing flexibility and agility you need to balance growth and protection to achieve your long-term nest egg goals. Outsourcing your investing to a one-size-fits-all balanced fund, robo-advisor, or cookie-cutter financial planner simply won't help you achieve what you want and need. So why is taking control of your investing so crucial, and how do you do it? The point of all this talk and numbers, which you can see in more depth in an article that you can find below in the description, is simple. If you don't want to say goodbye to the lifestyle you were accustomed to while working, and maybe even start contemplating decisions like whether or not to turn the heater on during retirement, you should skill up and take control of your investing. So if you're putting your financial future into the hands of others, I urge you to act now and consider your options for creating or finding a self-sufficient investing strategy, at least for some of your funds. One that has the highest probability of funding the retirement life of your dreams and gets you the best combination of annualized returns for the risk taken and effort expended. Hint and tip: aim for 14% returns with up to 30 minutes a week of effort. I'm not saying you should switch gears immediately, but at the very least, take a look at what else is on offer. Deep dive into how other investing options you can take have performed in the past, and assess their chances of getting you where you want to be in retirement, financially speaking. Do so in detail, and only then choose your investing system and strategy. If your choice happens to be becoming a self-directed investor, and you want help ensuring you turn into and return a consistently profitable one, you know where to find me. Whatever you do, at least ensure you're the master of your own destiny and financial future. Instead of putting that future in the hands of a corporation you're just a number to, and whose chances of getting you where you want to be in retirement are virtually non-existent, just as the numbers I laid out above have showcased. I trust you've learned lots from this video. As always, I wish you consistent and objective investing.